About 14 months ago, I started a portfolio with just $5,000. The goal to build it up as quickly as possible, using the strategies I talk about on this channel to the point that it can generate a full-time income. So of course, there have been ups and downs along the way, but that's the point, to experiment and learn so that we can all apply that knowledge going forward. So without further ado, welcome to the road to financial freedom. So as of the end of the trading day on February 9th, 2022, the portfolio is sitting at a balance of $14,615. And that's based on a total deposited amount of $15,250, as I've been making regular deposits into the portfolio of $100 every single week. So that means that the portfolio is actually down right now by $635, or about 0.35% money weighted. And I talked in depth about the reasons for this portfolio's underperformance in my 1-year update video, so I definitely recommend you check that out, especially if you're new to this series. But at that time, the portfolio was up in value and was actually outperforming the market. So what's gone wrong? Well, we all know that the market hasn't performed very well over the last 2 months, being that it's down about 4.5% year to date, and at one point it was down as much as 11.5%. But even so, over the lifetime of this portfolio, the market is up about 21%, so I certainly can't blame the performance on the market as a whole. But if you've been keeping up with this series, you know that the main strategy I use is covered call writing. And recently I've switched to selling more poor man's covered calls in this portfolio, as I found that selling covered calls on cheaper, less established stocks wasn't the most reliable strategy. And at the time, I actually warned that while I think this will help improve the long-term performance of the portfolio since I'm able to trade more established, solid companies like Apple, AMD, and Nike, there will be more volatility in the short term since I'm holding more options rather than individual shares. And that's exactly what we've seen play out. As the market has gone down in value over the last few months, my portfolio has gone down even faster. So only time will tell whether I'm actually right about the long-term performance, but in the meantime, I'm still very happy with the majority of my positions, and let me explain why. So I'm really in just 4 major positions right now, those being a covered call on ChargePoint and then poor man's covered calls on Apple, AMD, and Nike. So while I really like ChargePoint as a company, which I've talked quite a bit about in previous episodes, the stock hasn't performed extremely well over this past year. So if you remember, I used to own 200 shares, which I was selling covered calls against, but recently I decided to cut my losses on 100 of those shares. So I sold them in early January at $16.18 per share, and now I'm down to just 100 shares at a purchase price of $28.40 per share. So now I'm using those shares to sell covered calls at expiration dates pretty far out in time to collect premium as I wait for the stock to recover. So I do think that ChargePoint will do very well long term, and personally if I'm going to make an investment in the EV industry, I prefer to do it on a stock like this, which is already relatively established and successful, and that will benefit regardless of which EV manufacturers become successful in the future. Because as of right now, there's a lot of startup EV companies along with traditional automakers transitioning to EVs, so it's really hard to tell right now how that's all going to play out. But now when it comes to Apple, AMD, and Nike, I've discussed these stocks and it seems like pretty much every episode of this series, so I won't harp on them too much here. But basically they're still some of my favorite companies to trade right now, especially for covered calls. And of the 3, I like Apple and AMD the most. But all of the companies are showing extremely strong revenue growth even throughout the pandemic, and they're all solid companies that aren't going anywhere anytime soon. So they're the perfect example of the bread and butter of my strategy, which is to trade stocks with consistent growth that I like over both the short and long term, and in doing so, I don't need to worry about the short-term fluctuations in the market. So in the meantime, as long as I'm able to bring in solid covered call premiums from these stocks, I'll be satisfied. And I think that over the long term, as long as nothing changes fundamentally with my companies, I'll be doing just fine. So let's take a look at how my premiums are doing. Now, in case you're not familiar, my goal is to generate a return of between 2 to 6% per month in premiums. And over the last 2 months, December 2021 and February 2022, I brought in exactly 2.65% each month, which totals to about $900 overall. So those percentages are on the lower end of my goal range, but given the pullback we've seen in the market over the last month or two, I'm actually very happy with those numbers. And really what's allowed me to bring in larger premiums as a percentage of my portfolio is the fact that I'm selling poor man's covered calls, even though it does lead to more volatility in the portfolio. So I'm still very happy with where I'm at there, and once my companies and the market as a whole start to recover, I'll be able to reap the benefits of these premiums that I've been collecting every single month. So now before I move on to my other trades, I do have one important announcement. As most of you know, I've been posting weekly updates of this portfolio over on my Instagram account, but recently I started an email newsletter where I'll be sending out the updates instead going forward. So if you're currently following me on Instagram and want to continue getting those updates, go ahead and click the link in the description below to join my newsletter. Of course, it's completely free, and in addition to the portfolio updates, the newsletter will include some other occasional stock market related content. And if you only want to receive the Road to Financial Freedom updates, you will have the option to opt out of that general newsletter. But now with that out of the way, let's get back to the video. Now moving on to the other portions of my portfolio, I'm not currently holding any leaps options, simply because given the current market conditions, I don't think that it's a good time to be in riskier positions like that. Most of you know that I only like to enter new positions when I see a positive trend in the market, and given all of the uncertainty and volatility right now, I just don't think it's a good time for that. And especially not for me, since I already have plenty of risk and leverage in my portfolio through my poor man's covered calls. So back in January, I sold the one Apple Leaps that I was holding for a profit of about $310. And now I'm just waiting for the market to show a bit more strength before I feel comfortable getting back into a Leaps trade. Then regarding my long-term holds, I finally converted them all to index funds, as I've discussed in the previous few episodes. So they are down in value right now since I just bought most of them, but these are the positions that I plan to hold essentially forever, as they appreciate in value and provide some extra stability in my portfolio, which is very important to have, especially in this market. And if you want to see a recent trade that I made in my main portfolio, which is a good example of the type of trade not to make in this market, be sure to check out my most recent video right here. It was a great learning experience for me, and I think you might learn a thing or two as well. Either way, thanks a lot for watching, and I'll talk to you in that next video.